You have questions, we have answers. This is Jane Muller.
And this is Ken Muller. Welcome to our show, all about real estate with Ken and Jane. Well, to start off, Jane, today is Father's Day.
Happy Father's Day!
So we want to wish a happy Father's Day to all the hardworking dads out there. Yours truly. And
that's right. And Joe and Ken.
Yes.
Happy
thank you.
Father's Day.
Thank you. Yes. So we have with us as our guest today, Joe Urciuoli of Crown Mortgage to give us a market update and what's hot and what's new. Joe, welcome to our show.
Thanks for having me, Ken and Jane.
We're excited. It's our pleasure. So tell us briefly about Crown Mortgage.
Yeah, so we're a correspondent banker here in New Jersey. We specialize in lots of loan products, you know, your typical Fannie Mae, Freddie Mac, FHA products. We do everything in-house. All the underwriting is done in-house, so it's simple. I have a complete underwriting team and a processing team that we do everything. We have been in business now for quite some time, and I just joined forces with Crown Home Mortgage just a couple weeks ago, and I'm excited because I used to work for them back in 2019, and now I'm back with them, so I'm very excited.
All right, that's great. All right, so let's talk about what's hot. This past Wednesday, the 14th, the Fed Chairman Powell gave his speech. As expected, they did not raise the interest rates. So
that's the good news.
So they broke the record.
Yes.
They had previously raised it a historic 10 times in a row. So yesterday they did not raise it, but left the door open to future rate hikes. Possibly two down the road.
Yep.
It's speculative. I guess they'll wait and see. So right now the target lending rate is somewhere at the 5 to 5.25. Their rate is about 5 to 5.25%. So as we're in the summer now, we're in start of the summer. It's kind of scary because things go quickly when the summer starts. Before you know it, it'll be over. But so as we're in the summer now, where do you see the rates heading for the borrowers?
Sure. Yeah. No. Great question. So right now our interest rates are between that 6.5% and 7% mark on a 30-year fixed. There are loan level price adjustments that can push it over 7 and sometimes maybe even under 6.5. But right now, yesterday, they didn't do any type of rate hike. They're predicting there might be 2 more this year. But that being said, they are predicting by the end of the year that the interest rates, what they're trying for, is to be between 5.5 and 6, which is a great sign because that's going to open up the market. There's going to be a lot more refinances available for people that are in that 6.5 to 7 range or might even be in the low 7s. If those interest rates can get a tad under 6, that's going to open up the market and it's going to save people hundreds of dollars a month being able to refinance to do so. And it's going to open up more buyers because they're going to want to purchase on that low interest rate. So right now, for the next couple months, they're predicting that they're going to stay put around that 6.5 to 7 range. But by the end of the year, they're hoping that they're going to dip below 6. Basically, we have to have a softer job market right now, and that's going to kind of be the telltale sign.
Right. And isn't it quite interesting how everything is so relative? A year ago, if we were sitting here and you said the phrase interest rates could drop below 6, which is great, people would have looked at you like you're crazy. Yeah. But a year later, everybody gets acclimated to a high. So everything in life is relatively norm. Back when Jane bought her first house, the interest rates her rate was 13%.
Yes.
So many, I won't say how many years.
Don't tell them. You'll show my age. But by the way, for the audience out there, right? I bought my house when I was in nursery holding my milk bottle.
Yeah.
Otherwise, you'll know my age.
Right.
And when I first started in 1997, I was selling 9.49.
Yeah.
So on a mortgage. So it's come full circle.
And you started when you were like 15, right?
No.
Maybe 7.
You couldn't get your license then. You couldn't get. You have to be at least 18 or so.
Yeah. In 1996. Yeah.
Yeah. Well, Ken, that's all your fault. It's a Father's Day. We forgive you.
Right. But here's a very interesting thing that we're experiencing as real estate agents. Despite nobody saw it coming, despite the relatively higher interest rates this year compared to last year, the market, the Central Jersey real estate market, remains very strong.
Yes.
Which I guess you're experiencing the same.
Absolutely.
Borrower interest in applying for loans, right?
Yeah.
There's still the need and the want.
And there's a very large buyer's pool right now. Lots of pre-approvals are being done, despite the interest rates to some seem high, but we feel that it's the norm. And large buyer pool, so much so that there's a lot of buyers out there overbidding on homes to try to get that same cookie cutter home, being the low inventory right now. So as long as inventory grows, more and more people you're going to see start getting those homes a lot faster. And there's going to be less bidding wars on homes right now. But guidelines are the same, still the same. More and more people I'm approving every day, which is a good thing. And they're out there searching for homes. They're putting bids on it. Most of them don't get discouraged. Most of them definitely want to be in, especially it being summertime right now. Everybody wants to try to be in before the school year starts in September because they want to register their child for that new school system.
You know what? This year and the last year is totally different, Joe, right?
Yeah.
I still remember that I called it bloody June 16th, right? That day, the market, I think, they increased 75 basis points that day. And the market went crazy.
Yes.
The rate went up. So that night, I never forget, that very night, 3 deals of mine just canceled.
Yeah.
2 in attorney review. Obviously, the buyer didn't lock in the
rate. Otherwise, it would have been irrelevant.
Yeah, they didn't, because normally they wait for under contract. They will apply the mortgage, lock in the rate. They didn't lock in the rate. One, in fact, we're already under contract, but somehow they didn't lock in the rate. Maybe they think the rate will go even further, or the mistake they made, or some human error forgot. Regardless, right? That buyer under contract no longer qualified.
Sure.
And the 2 under attorney review still qualify with a suddenly high jump rate, but that's really cut close to their comfort zone. I mean, as the buyer put it, right? I mean, I don't want to buy a beautiful home and be home poor, right?
Absolutely.
I don't have to think about, should I pay my mortgage or should I buy my child a pair of new sneakers?
Yep.
Or a vacation or anything, right? Furniture, whatever. So at that time, the market was silence after 16th. I can tell you, I still remember last year, my phone, pretty much the only call I get is a frustrating seller. And then the buyer start to, even under contract, home inspection is tough. Everybody try to renegotiate, try to get out.
Sure.
So that was really, really not fun last year. From June to December, the market definitely, in our opinion, in our experience, went down at least 5-10% in Central Jersey. So thank God in January, probably everybody feel used to it, immune it, and they will come out. And plus the inventory went down. So that's really helped. From January to now, June, the 6 months has been steady. The price was steady.
Let's talk one thing about the lock rate while we have Joe here as the expert.
Yes.
Explain how the lock rate, how locking in the rate works, and when the buyers typically do that in the process, and what's the flexibility with that?
Excellent question.
Yeah, while
Excellent
we're on
question.
that.
So this is what I do personally. Not everybody does this, but this is what I do personally. Once you tell me that an offer was accepted on the borrower, that's when I'll register the file and I'll lock it in, and I'll lock it in according to the contract, the date of closing on the contract. Make sure whether it's 45 days, 60 days, sometimes even 90 days. I will make sure, because the market right now is so volatile and every day it changes and fluctuates so much, that I want to do a great service to the borrower and lock them in before they go any higher.
Yes.
So,
right. And they can lock it. I'm sorry, and they can lock it in for as long up to
90 days.
Up to 90 days,
yeah.
Right? And then could they further lock it in if they
yes,
want, if they're willing
we could
to
go
pay?
a little bit for if they want to pay a point or two or a premium, prepaid interest. We could do a long-term lock, but the most of the locks nowadays are 60 days.
60 days.
Yeah, the best rate. Otherwise, you have to pay for the privilege.
Yep.
And what was the reason, Jane, in your experience with the clients that didn't lock in back then, before that Fed drop? Why? Because before that, the rates were still relatively good, but some of your clients still had or some of the buyers out there still had the expectation that the rates were going to go further down, even though prior to the Fed's speech, they
look it back, right? First of all, that's all I represent all the sellers in this case, right? I think, I'm not sure, I'm just guessing here, right? The possibility could be the buyer, maybe first-time home buyer, they may not be experienced, and buyer agent maybe didn't even explain. I'm not saying the agent or a mortgage officer didn't do their job. Maybe they were just, and some buyers, right or wrong, right? Some buyers wouldn't apply loan until they finish home inspection.
Correct.
Negotiation.
And some loan officers do that.
And they were spoiled because they figured that the gravy train with the low interest rates was going to last forever.
Yeah,
so they just
that's
figured
what happened.
They took it for granted and didn't bother, didn't think locking in was a prerequisite or any urgent sense of urgency.
Yeah.
Plus, they jumped up so fast, so quickly.
Yeah, one day.
It was like by the 75 points, it really was like a tidal wave.
1 day.
Yeah, one day. So one day, 3 times, I thought it was like a boom, boom, boom. That was done, right? Yes. I think that time, the some buyers still thinking, right? I'm under contract, so they have a home inspection scheduled. After home inspection, they have a 60 closing. Most lender will say we can do it in 30 days, right?
Correct.
So you have a 1 month. So you did the review, and then you have 14 days for your home inspection contingency. Once it was settled, and then you go lock. Correct me if I'm wrong. If you lock in the rate 30 days, you may get a little better rate too.
A little bit better.
So that's another reason.
Oh, but it's the risk alternative. The lesser, if you take a chance and lock it in only 30 days, but then if you lock it in 30 days, usually the closing is typically 45. Oh, so you wait till you're under contract and you do a home inspection.
That's exactly what happened. They under contract did a home inspection. After home inspection, they're waiting everything. Once it was settled, and then they gone to lock in rate in 30 days and close.
Yep.
But otherwise, they don't want to pay for appraisal. They don't want to do that.
Correct.
But in that month, June last year, there was just like a tsunami came.
The world,
It's like a world turned up quick.
It was quick.
That was quick. And then that's why they were underwater. That's why they didn't lock in the rate, because they but what can you do?
The good thing is, like we talked about earlier on the way in, the consensus right now is everybody's understanding what the rates are now. I think they're understanding that they're not going to dip below 3%.
Yes.
And that was an artificially suppressed due to the worldwide pandemic.
Absolutely.
So that's not going to happen again.
Yes.
All right, we're going to be right back. We're going to take a short break. We'll be right back after these messages. Okay, welcome back to our show. Today we're joined by Joe Urciuoli of Crown Mortgage. Joe, please share with us your contact info for the listeners.
Yeah, thanks, Ken. So if anybody out there wants to contact me, they can call my cell phone at 908-307-2374, or you can email me directly at Urciuoli. It's spelled URCIUOLI at crownhm.com.
Okay, perfect, great. All right, so we covered some historic events from last June. So let's step back and let's talk about the current the pre-qualification process. Let's go to Mortgage 101. Talk about a little bit about the debt to equity ratio, what you look for, and then we can talk at the end of the show about some of the new products you offer too.
Yeah. So if a customer calls me today and I have to do a pre-approval, I'm looking at 3 things. I'm looking at their credit. Nowadays, what we do is we do a soft pull, which is very important because we don't want to do a hard pull and have their scores drop off a credit inquiry. So we do a soft pull for the borrower. We also look at their job and their income. And then the third piece of the puzzle that we look at are the assets, making sure how much they have, how much they want to part with for down payment, plus closing, plus the escrow reserves for taxes and insurance. So debt to income ratio is a big piece of that with the job and income. On a conventional loan, there's a front end ratio and there's a back end ratio. Okay. The front end ratio is important because what that is basically just the new mortgage payment, principal plus interest plus taxes plus home insurance on a monthly basis divided by their gross monthly income. That in most cases, you want to be below 46.99 in order to get approval. Okay. The back end ratio is a total of the PITI in the mortgage plus any other outstanding debts that they have. Make believe they have an auto loan for $400 a month. We include that plus the mortgage. Make believe they have student loans. We take whatever the balance is and times it by 0.5%, and we add that to the debt. That in most cases don't want to exceed on a conventional loan past 49.99, and on an FHA loan, you don't want to exceed it past 56.5. Okay, so that is a way to do it and still get an approved eligible for the borrower.
Oh, that's very interesting. So you have two ratios, the front end and the back end. So that's quite.
The first one is just the housing part, and then the second part is the housing plus all other outstanding debts.
So you could have applicants that qualify based on their ratio for the housing ratio, but because they may have multiple car loans for luxury cars, that could put them over that 49 point whatever percent. So and then yes. I guess then it's a judgment call, or they automatically, if they don't meet both the ratios, then it comes to the underwriter to decide.
Then you just can't do it at all.
Or just can't do it.
If
you just
it exceeds
flat out,
the threshold, you can't.
Those are fixed, pretty much rigid thresholds. They have to satisfy both the front end and the back end.
And the back end. And I just had one recently that didn't have any debts at all. None. Zero debts. But the housing that they were looking for was too high for their income, and the debt ratio was like 52%. So both the front and back was at 52, and it can't be. It has to be below 46.99 just for the housing one.
And do you remember the other one, Jane? 49 point. I want to see if you're paying attention. No, that was hard. I don't remember. I know it's 49 and 40.
49 conventional, 56 and a half FHA for the back end. Yep.
I've never been a detailed one.
Yeah,
but you just understand the concept. Conceptually, yes. You have to qualify right.
And that's why you have professionals like Joe to help them.
And we've covered this, and you've covered it many, many times. That's why as a good agent and as a good loan officer, you always tell the buyers, please, once you're pre-qualified, don't do anything crazy, and don't go out there and take another car loan or a loan on
vacation,
jewelry or buy a $20,000 diamond or something like.
I tell this story.
Ooh, $20,000 diamond.
I don't even know if they. Well, no. I'm sure.
No, I do explain
because
that.
that's happened time and time again where people just figure they're pre-approved. They figure, well, let's get some furniture for the house. Let's get another car. We're going to have a garage now. Let's get the new car and get ready.
I had something even funnier. They bought a house and they going to close the end of August, mid-August, right? And in July, their relative overseas came. So they will show them around. I mean, obviously they make appointment to see the house, their new home. They're not going to close yet, but they want to let the family to celebrate with them. And because the family came, right, and when they purchased, they just used their credit card to purchase a lot of gift and everything.
Sure.
So, and then when the time comes clear to close, and they're not almost
didn't qualify because they did a refresh report.
So quickly they have to, pay that and get money from, the retirement, whatever they did. So they have to get that. You have to pay down the credit card, but it takes days for that reflect on the balance. Absolutely. When they pull again. So we couldn't close at the end. They couldn't close till early part of September. So, that's...
Lenders, what they do is a refresh report the day before closing. It's not to see if the scores changed, but it's to see if they incurred any new debts. And if they did, that may impact the credit score. The debt-to-income ratio, and you might have a problem with the closing then.
Right.
Yeah, and then it was
and
like
you've experienced that, unfortunately.
True story. I once had a customer that needed a new car. He got into a car accident, but he was smart enough to actually call me from the dealership, put the salesman on the phone. I asked the salesman what the new car payment's going to be. He told me it was make-believe $350. I typed it in, and he was still able to qualify. So at least the consumer listened, which is a smart thing.
Which is smart, yeah.
Yeah.
Absolutely. Also, while we're talking on good housekeeping practices, let's talk also about what else to other things like with gift letters and transferring large sums of money between different bank accounts.
Yeah.
Some good housekeeping practices. Then we'll talk about the new products you have.
Yeah, no, I appreciate that, Ken. If you are out there and you're thinking about buying right now, the first thing you want to do is stop transferring money from one bank account to another, from checking to savings. What that does is, I don't want to say it confuses the underwriter, but it makes for more paperwork for you as a borrower to get to the underwriter. So stop transferring money. We can use multiple bank accounts for assets. It doesn't have to be one. So if you have, make believe, 4 different accounts and 2 being checking and 2 being savings, or a money market account thrown in, we can use all of that. What we look for is the last 60 days of bank statements, and nothing going in can be cash deposits or anything that we can't source.
Yes.
Okay,
Right.
so if you have money laying around, do not put that into your bank account unless it's over 60 days, because then we can't use that as a source of a down payment.
Right, because some people may have cash and they may decide let me put that cash into the account so I get it ready.
Correct.
They may put $10,000 in. That's literally their cash, but
Yes.
they can't source it, so then it becomes
And a lot of
problem.
time is the family gift as well. You know?
And then you need a gift letter.
I mean,
and then
yeah,
You need a gift
sometimes
letter
the,
and the donor's
family-
bank statement showing the money coming out.
Their
and
account.
then the money
Oh, you
going
need
in.
the donor's bank
The donor's
account.
bank account.
Oh, okay.
Yeah.
Yeah.
For at least 15 days, the donor's bank account showing, make believe it's a $10,000 gift. $10,000 has to be coming from the donor's bank statement.
Mm-hmm.
And then we have to show the borrower's bank statement with the $10,000 gift going in.
Mhm. So that's a match.
Plus the gift letter. Yep, it all has to match.
Right.
Because a lot of time it happened, the auntie, the uncle, so
Yes.
they do
Yes.
help.
Yeah, and then you have to explain to the borrowers, because they think, it's a good thing when money comes in, which is a good thing, but you always have to source it and make sure that it's accounted for. And I guess the reason is the lender wants to ensure that there's no liability or repayment expectation, because that would
Correct.
throw off the debt to equity ratio. So that's the whole.
Exactly.
So they have to source it and have a gift letter for the file to
Yeah. Mm-hmm.
verify that it was truly a gift.
Yeah. Another good housekeeping rule is, if you're thinking about buying in the future or very soon, do not think that you're going to pay off a credit card down to zero and never use it again and call and close the account, because it's a revolving history and it's a positive history. And if you ever close your credit card account, your credit scores are going to drop, and it could drop between 20 to 40 points.
Oh my
Really?
God.
Overnight.
Oh, interesting.
Yes.
So less isn't always better. Keep it
Correct.
open. Yeah.
You could cut your card and never use it again, but do not call the liability and say, I want the account closed. Don't ever do that. That's for revolving credit only.
Interesting.
It doesn't matter if a car installment loan is closed, because we all know that once we pay off a finance installment loan, the account closes automatically. That will not affect your score. It's strictly for revolving credit.
Interesting. Very interesting.
That's a news. And
Yeah,
it's good
that's
to
very
learn for
a
the
lot of great
audience out there.
information.
Yes.
Yeah. So let's talk about some of these neat products we were talking about before the show started. Namely the investor
Debt
program,
service
debt
loan.
service
Yeah.
loan that you
Yep.
were talking about.
Yeah. So what's popular right now, most folks out there right now are looking to buy investment properties because, let's face it, even though the interest rates are higher than what the norm thinks, it's still very popular to buy investment properties right now. So this debt service loan is very simple. We don't care about job and we don't care about income. We leave that blank on the application. As long as you as a borrower own a primary residence, you can purchase an investment property with 20% down, with as little as a 640 score, 640 middle FICO score, and all we care about is that the investment property that you're looking to buy, the rent is at least $1 more than your principal, interest, taxes, and insurance payment. That's all we care about. So basically, the rent is going to debt service the house, and we don't care about the borrower's income. So it's great for the self-employed borrowers writing a lot of income off. It's great for the 1099 employee. And it's a great product if you're looking for an investment.
I have
Let's
a
talk.
question.
Wait, let's.
I have a
okay,
question.
go ahead.
Yes.
Say you said it had to be $1 more. The rent has to be $1 more than your mortgage repayment, right?
Yes.
But if you buy a investment property, if that property not currently rented, say if I buy 123 Main Street, right? That property at the moment is self-occupied.
Yes.
But I don't know actual rent until I.
That was my question
Yeah.
too. Can you buy a vacant or a self-occupied or a
Yes.
non-rented property?
Yes.
And then the follow-up question would be, if that's the case, then
What do they look at?
how does the lender evaluate what the rent will be?
No, great question. Very common
was very
question.
common,
Yeah,
yeah.
absolutely.
Yeah.
I appreciate that. Simply put, the appraisal. When we order the appraisal on the property, we're looking for the market rent. So the appraiser has to put what the market rent is on that property. And as long as that market rent is $1 more than the customer's principal, interest, taxes, and insurance payment, it debt services, and then we're able to still close.
Oh, that's that.
And they can
that's
close with
fair.
the investment property vacant.
Correct.
There's the expectation. They don't care if that's a
Correct.
great thing.
Correct.
Yeah. And then getting back to the requirement that the investor must own their principal residence, have a credit score of 640 or higher. Is there any amount of equity that they need in their principal residence to qualify, or they could as long as they own it, as long as they have title to it, they could own it 5% of it. It doesn't matter the
it
extent
doesn't
of the
matter.
mortgage.
And right now, what people are doing is they're cashing out on their primary residence for the 20% to put down on the investment property.
We're almost out of time, but talk quickly about the cash out, the other neat program.
Yep, cash out program, cash out refi on your primary residence. If you're looking for college tuition, pay off credit cards, or even to put down a down payment on another property, whether it's a second home down the shore or an investment property, you could do a cash out refinance and tap into the equity on your primary residence in order to do all of those types of things.
All right, that's great. Really good stuff. Joe, once again, please give your contact information. I'm sure some people will want to find out further about these programs.
Thanks. So it's Joe Urciuoli, Crown Home Mortgage, and my phone number, my cell phone is 908-307-2374. And again, my email is jurciuoli, URCIUOLI @crownhm.com.
Great, Joe. Thank you so much.
Thanks for having
coming on
me.
our show. We're out of time. We'll see everyone next week.
Happy Father's Day.
Happy
Let's
Father's Day.
celebrate.
Yes, Happy Father's Day.
Happy Father's Day.